Thank you, Fraser, and welcome, ladies and gentlemen. I'm Dan Ridsdale. I head up the technology business at Edison, and this theme, as Fraser said, is on artificial intelligence. This is actually a repeat of last year's conference. We looked at the thematic last year, and an awful lot has changed since then. We've seen a real proliferation of AI models, a succession of breakthroughs in performance. We've seen the emergence of DeepSeek to really challenge the US NVIDIA sort of hegemony, if you like, making us realise this is going to be a more diverse landscape than we previously thought. And we've also really seen the emergence of agentic AI as a real technology theme that is actually happening. One thing that hasn't really happened, however, is that we haven't seen a real influx of AI-enabled, AI-native businesses onto any indices, really, or specifically the European indices. In fact, we've seen more of our leading AI companies move off market with, for example, Winwood, who presented last year, being taken over, Darktrace being taken over, and so on. So that's part of the reason why we've really focused on investment companies this year. One of the best ways to get exposure to this theme is by, as Fraser said, investing in the experts. And we've got 3 companies really representing different stages of the capital life cycle, from Polar Capital, representing global listed equities, HG, transatlantic European private equity, and we've got Molten Ventures representing European international technology venture capital. So without further ado, we'll get going. First up, representing listed capital, is Patrick Struff. Patrick's an investment analyst at Polar Capital Capital Technology Trust. This is an investment trust that's focused on the global technology sector, really with AI at the heart of their investment philosophy. The company's recently been listed in the FTSE 100, and it's got one of the largest and most experienced teams in Europe. Patrick.
Good morning, everyone. Thanks for the time today. As Dan said, I'll try and just give you a brief overview, quick insight into how we at sort of Polar Capital tech team are thinking about AI currently. Look, clearly AI is evolving rapidly, and some of what I'll say today in 4, 5 or 6 months will be out of date, but that is a reflection of how fast the space is moving. The market is extremely volatile, macro is uncertain, we're getting tariff headlines every hour, let alone every day. And basically until yesterday, after the US China announcement, investor sentiment was extremely negative, and actually still is pretty negative. However, the AI narrative and the AI data points have not weakened, and in fact, they've actually strengthened. So firstly, the question we get asked a lot is, where are we in the AI cycle, and where are we, and are we in a bubble? Lots going on in this slide, so apologies if you can't quite see it. But also we think fundamentally the answer is no. In fact, we're merely at the start of a massive investment wave for AI. There will be pullbacks, there will be doubts, but right now we're nowhere near bubble territory. The most obvious way to look at this is on valuations. Tech is not expensive currently. It's about 1.2 times the market, 25 times PE. This reached 40 to 50 times in the mid-90s and almost 2.6 times the market at peak. You can buy NVIDIA on 1.3 times the market multiple. And then more interestingly, there's probably some softer signals that we look at regarding whether we're in bubble territory or not. There is not really a single IPO coming to the market. We may be getting one a month, maybe one every 2 months if we're lucky. During the 90s, it was a steady flow of IPOs. So we'd wait for some big companies to come public, the likes of Databricks or Stripe, but currently we're not really seeing that yet. Also on the VC side, these guys will be able to talk to more later, but VC investment is really just back to 2021 levels. So the private funding and the private market activity is nowhere near the levels we would expect for bubble territory. So we don't believe we're in a bubble, so why are we so excited about the AI opportunity? Apologies if you've listened to Ben Rogoff speak before, you've probably seen this chart. But ultimately, AI is a general purpose technology, which means it's a technology that has broad applications and can significantly transform economies and societies over time. And ultimately, the impact of which, or the impact of the general purpose technology, is typically not recognised, and it is underappreciated at the time at which the change is happening. AI is a modern day GPT. Now, we use the example of building heights. So basically, for all of human history, up until the mid-1800s, building heights were pretty much exactly the same. And it wasn't until Bessemer steel and the Otis elevator came along that we saw massive innovation and change in productivity. Building heights shot up and increased 25x in just 46 years. If you were around in the 1850s, you would not believe what cities would look like by 1930. We believe ultimately AI is following a similar path. As can be seen on this slide, which plots model progression over time, and you can see a big inflection here with the advent of the transformer model. So ultimately, we believe models in 10 to 15 years' time will look nothing like they are today, and we are underappreciating the size of that market. So the models are getting better, smashing benchmarks. However, they do come at a cost. I'm sure everyone would have heard about the DeepSeek moment from earlier in the year, sent shockwaves through the markets. It was a pretty horrible Monday. But ultimately, well, at first glance, DeepSeek R1 model was thought to show massive increase in performance at a massive reduction in cost. However, it's now widely acknowledged that that cost argument was false. The $6 million number that they claimed was more like 1.3 billion. The 6 million was like running the kettle, but they didn't factor in the price to build the kettle, to connect it to electricity, to run the grid, and so on. However, DeepSeek was still an important moment in this sort of the AI cycle for us. And what it showed, this graph on the right-hand side, is we're plotting sort of model progression over time. And you can see that DeepSeek just continues the cost improvements that we saw at other models. The cost improvements of 40x per year. DeepSeek just continued that. Mistral, a French company, had actually released a similar model with the similar cost benefits, but frankly no one cared because it was French, not Chinese. So the conclusion from DeepSeek was that you get continued improvement along the cost curve, but ultimately this was not unexpected from our point of view. It has made infrastructure trade slightly more complex, and now there is a large bear case that the market sees perhaps longer term with hyperscaler capex. So on that, post DeepSeek, market was in a frenzy. There are also concerns around Microsoft cancelling data center leases. And for us, hyperscaler capex is the number one metric that we track in the public market for the progress of AI and the attitude of the largest tech companies in the world towards AI. There were fears of capex cuts, and ultimately, we didn't just see capex maintained, but it was even raised at Meta. DeepSeek ultimately made no differences. So the valid question is, how much further can this continue? Companies did imply that 26 would see further growth. Now, we use another example from the 19th century, but you look at railroad capex as a percentage of GDP. Now, of course, look, it ended in a bubble. It peaked at 3% of GDP. We view AI as a similar GPT to railroads, and AI currently as a percentage of GDP is only 0.8%. So look, of course there's going to be cycles and so on, but we believe we're nowhere near the peak for hyperscaler spend. So I guess it begs the question, why are hyperscalers spending so much? We now we view this into three reasons. First reason is defensive, and I think probably the most alarming from a hyperscaler perspective if you're Google. And the chart on the right shows traditional search share versus AI agent search share. And you can see that AI search is increasing and has actually inflected positive. Well, it's accelerating further. And actually this chart was updated by Wells Fargo yesterday with AI search reaching 9.1%, so accelerating even further. Hyperscalers have to spend to defend against the oncoming threat that AI poses their business. Second reason is offensive. Hyperscalers are arguably some of the best businesses in the world with some of the best talent. And actually some of them have been able to develop amazing AI revenue currently. Meta has a $20 billion ARR business called Advantage Plus for advertisers. And Microsoft Azure, half of Microsoft Azure's growth last quarter was driven by AI. So it's also an offensive element to this. And then thirdly, there's sort of the optionality, and this sort of comes to the idea that there are new markets going to be developed. And we just example of 3 here. We talk about agentic AI, the idea that sort of software will be basically taking actions on humans' behalf instead of sort of helping humans. We have embodied AI, which is the way in which large language models can now be used or integrated alongside robotics to perform tasks, and then ultimately AGI as well, which is the end goal for many hyperscalers. So where does that sort of leave us and Polar Capital from a sort of investment perspective? Look, the market is extremely volatile, and there is a less certain AI investment narrative. However, that's at odds with the strong fundamentals that we see in the market. Market corrections are expected. You saw 15% plus downturns in the mid-90s. So what we've seen this year is not totally unexpected. The Mag 7 has driven the majority of gains over the last few years. However, we see a real risk to some of these companies. Google for one, Apple for another. And then there are others that seem to be real winners here, Microsoft and Meta so far. So it's deeply important from our perspective to be able to avoid the losers as change happens rapidly, but then also identify the clear winners. Right now, we sort of lean towards a preference on the infrastructure trade, this is the build out of data centers and so on, but over time that will probably evolve to more of the beneficiaries and the companies that are applying AI internally. So happy to take your questions later, but thanks for
Thank you, Patrick. One question to start off with. You talked about DeepSeek and also Mistral in France, and also how your portfolio is currently weighted by necessity really towards the infrastructure and semiconductors, and also towards the US and I guess to Asia. Where do you see Europe in all of this, and do you see that dynamic changing? And I think you touched on this.
Yeah, I think it's going to be very hard for Europe to build a new hyperscaler. However, ultimately the infrastructure build that's required to build these new data centers, AI-powered data centers, to modernise the grid, Europe has got some great companies in that. Siemens Energy, Rolls-Royce has an amazing power gen business. So there's plenty of opportunities on this infrastructure build in Europe and the UK. And then also there's plenty of companies that we meet that have an amazing culture and attitude towards adopting AI. I mean, RELX is in the UK is arguably one of the best AI beneficiaries globally. We also speak to Tesco, would you believe it, who are big adopters of AI internally. So in Europe and the UK, we've got to look beyond the sort of hyperscalers into more of the beneficiaries over time that we're talking.
Thank you. And do we have any questions from the audience? Patrick? No? Okay, so we'll move on and we'll have more questions for the wider panel at the end. So next up we've got Luke Finch from HG. Luke is a partner at HG. HG are one of Europe's largest technology investors, and actually if you aggregated all of the businesses they invest into, they would be one of Europe's largest software companies. It's a private equity business, and it really focuses on building businesses with a drive towards digitalisation and looking towards the businesses that transform the workplace. Luke?
Thanks, Dan. So yes, you stole my thunder there. We are We're kind of one of the largest technology investors in the world now at HG. We manage about $85 billion of client capital. HG Trust is our largest single investor. It's about £2.5 billion of market cap now, FTSE 100 member, and it invests in all of our funds. What we have got today in the portfolio is over 55 companies. We don't own 100% of all of them, but if you do aggregate those on an enterprise value, it's about $160 billion of EV, which would put us kind of second behind SAP. And interestingly, SAP is the only European business, arguably it's not European, but the only European business in the sort of global top 20 software companies. So it does make us a very scaled player. Those 55 businesses that make up the portfolio today, they are all in B2B software, B2B data, or B2B tech-enabled services, predominantly software. And what we love are the kind of boring, unglamorous core systems of record. It's your tax software, it's your payroll software, it's your account reconciliation software, it's your RegTech if you're a bank, it's your outsourcing management software if you're in the pharma industry. It's the stuff that's sort of working away in the background, helping your teams and your businesses be more effective and more efficient. And so the big question we're getting today is, well, what does AI mean for that software space? You know, big questions around what will happen to software, to B2B software, to SaaS software in the age of AI. Now, the good thing is we have a great big laboratory now at HG. We've got 55 companies, thousands of employees, and we're a big beast. And so that allows us to experiment and to play and to invest in this. So we have over 300 Gen AI projects now running across the portfolio. We've actually got 25, or more than 25 products now running out of our portfolio companies, several of which are now generating kind of ARR. We have a team of over 20 AI data scientists, experts at HG, working with HG business cards, and they're working with over 100 kind of AI engineers across our portfolio companies, and 70 plus, I don't know what the final number is now, advisors kind of in the network working almost exclusively for us. And then beyond that, we have really close links now into Silicon Valley, into some of the VC firms, and into some of their the startups they're backing. We took all of our CEOs over to Silicon Valley in January for what we called AI immersion therapy. So kind of they certainly felt it after that. But where we had the CEO of Anthropic, the founder of Cognition, folks from the Microsoft team really come in and talk about what they're seeing and what they're seeing kind of enterprise customers adopt. So that's our lab. It doesn't mean we're going to get everything right, but I think it means we are watching things very closely. And we're thinking about things on two fronts. One is operational efficiency. How can our businesses run better using AI tooling? And then the second is sort of more offensive. How can they productize AI and deliver more value to their customers and sort of ride this generational change? So on the margin side, on the operational side, what we're really starting to see now is a very interesting ecosystem of AI native businesses, I'm afraid they're all in the US, that are starting to provide really powerful tooling for businesses. And for our kinds of portfolio companies, two areas that really matter and we're seeing great efficiency gains are in customer support, so that's your call centers, customer success, and in R&D, so that's your software engineers. And we've actually agreed partnerships with 4 companies here, shown with the handshakes. So Devin, which is a coding assistant built by a team at Cognition AI, fantastic bit of kit. We're seeing 30 to 40% efficiency gains for some of the engineers across our portfolios in using this. And we've signed a big partnership agreement, so any one of our portfolio companies can now kind of get on Devin. If you're a smaller standalone business right now, particularly in Europe, an SME, trying to get that software, there's a big queue. They don't have the compute and the capacity to satisfy the customer demand. So our portfolio get to jumped the queue on that, and same at Thorfort. Thorfort's very interesting business, helping automate. It's an agentic piece of software automating call centers and customer support. In a number of our businesses where that's been adopted, the Thorfort agent is now getting voted by customers Employee of the Month in terms of saving them, in terms of solving their problems. So that is quite interesting. And then on the revenue side, how are we thinking about it? Well, these are pretty budget graphics, I'm afraid. I did this myself. I should have used Claude to do it. But software. What's software done for the last 20 years? It's been deterministic, which means it's rules-based, and it's very good at automating numbers, taking databases, applying rules onto them, and coming up with a correct answer, the one answer you need. So for things like payroll, tax reporting, software's been great. It's improved over the last 20 years. What does Gen AI do? Well, it's a completely different toolkit. It's a completely different kind of software in a way. It allows software to now go after probabilistic asks. So draw me a picture of a unicorn running down a beach with a 911 beside it. You can do that, you can type that in, and you'll get 50 different versions of that. And all of them are correct to an extent, none of them are the answer. And so it can create, it's generative, it creates answers. So, I like to sort of very simplistically compare deterministic software to screwdrivers. What was the task we needed to do? It had to be quite precise. And probabilistic it's completely different. It's a paintbrush. You would not use generative AI to file your German tax returns because you go to jail in Germany if you file your tax returns wrong. Doesn't mean it's not an incredibly useful tool, but it's useful for something else. And then as you think about the evolution of these Gen AI LLMs and basically taking them, stitching them together into what we're calling agents, so agentic solutions, where you take multiple LLMs and they're iterating around a question and they're referencing it with each other and other databases, and they're coming out with a more and more accurate answer or creating more and more useful output. So what it's allowing us to do is go after a huge new addressable market for software. And so we think about our portfolio companies and we say, great, you have been doing payroll in Germany for the German Mittelstand. Right, have a think about your customers and what else you can do for them with this new software. Yes, you've been very good at getting everyone's pay slips out per month. What around that processes can you start to do for your customers that you couldn't do before? So, we are incredibly excited about the opportunities Gen AI throws up because it's allowing us to think more about the workflows that we can solve. And then I won't take credit for the what we're doing here. This was a phrase that I heard the CPO of OpenAI use, the fractal complexity of the last mile delivery. So you speak to OpenAI and they will say, well, we're not going to try and solve every workflow in the world. We're going to build the tooling underneath that can help them do that because there are a million different processes out there that Gen AI can do, and we can't and we shouldn't go anywhere near them. What do we mean by this? What we mean is that, think about your own businesses. How many different processes are there? How much does the software need to understand the inputs, the data, the linkages around it? That's where we think there's a huge opportunity. It's the same as it was with deterministic software. Microsoft does not solve every single workflow in your organizations. It's an underpinning for lots of things, but you will have specialist software systems across a number of workflows. And we think that's the same for SaaS in the age of generative AI. Now, if you stick your head in the sand and you ignore it and you say, well, this doesn't matter, our customers need us, they give us their data, we solve this workflow for them, and you don't invest in AI for the next 4 or 5 years, then someone's going to come and eat your lunch. But as an existing provider of solutions to corporate customers who are, you're trusted, they're giving you their data, you're giving them back the answers, you're inherently rigged into their workflows. By adding AI tooling on top of that, we think there's a huge opportunity to expand what we're doing for our customers. So we think this is an incredibly exciting period for SaaS software. It will be disruptive. There will be winners and losers. But for us, we have a huge science lab where we can see what's working in one business, roll it out elsewhere. We can shortcut the learnings, and I do think that it's going to be a fascinating time. I wouldn't fancy being a CTO standalone today and wondering how to play this, because I think there's just so much coming at you at 1,000,000 miles an hour. But being part of a family of 55 companies and hundreds of experts, trying to filter that and look what's going on, it's incredibly exciting for us at the moment.
Thank you, Luke. And I should have mentioned you can get access to HG through the HGT, the trust. The details for that are in your programs. One question for me, if I may. You put a lot of emphasis on terms of how you are supporting your companies with the implementation of AI and so on. How has the evolution of AI influenced how you put money into, how you select new companies to invest into, and has it changed the equation in terms of investing into your existing portfolio versus putting money into new businesses?
Yeah, it's a good question. So I think it's reinforced some deeply held beliefs for us, which is, it comes back to that last slide. What's the complexity of the workflow that you're solving for your customers, and how embedded are you in your customers? Now we've long focused on that, because you don't really want to be investing in software that when times are good, it seems sensible to have this bit of kit, but when times are bad, it's the first thing that the IT team put a line through when they're asked to trim their budget by 15%. So it has to be a kind of mission critical system of record where your customers need to trust you and are frankly delivering data to you that you're kind of monetizing back to them. So that's that's been completely reinforced by everything. We've steered away for the past decade from sort of old legacy on-prem software, because we felt you can't, it was a very clear direction of travel that you couldn't serve your customers the right way if your software was sitting on a server in their basement and you couldn't see how they were using it. And that's even faster now with AI. If you don't control that data and you can't see the clicks and you can't see how your customers are using your software, you're dead. I think the other thing that we're then looking at is what are the, coming back to what I just said, what are the workflows around this? How many human touch points are there in the mix that can now be disrupted by AI? And that's an opportunity and a risk. If those human touch points are kind of almost too easy to disrupt, that's scary for us, and I'm sure it's very attractive for the VC community to go after some of those. And then the final bit, I think, is around the founders and the management team. How bought in are they? If they're sort of sitting there, they should have some fear right now, but they should also have some get up and go and see this as a real opportunity. And I think if they're, if we're talking to them and they're sitting back and sort of complacent about the relationship they have with their customers or their data today, then that will turn us off.
Thank you. Do we have any questions from the audience for Luke? Tom? I think the microphone's just right.
When you showed the list of the big players, and you said they're nearly all American, I just wondered, and we've all got our theories, I wonder what your theory is as to why that's the case. And the fundamental reasons, and the second question I had was, all this tariff stuff going on, could that ever touch this industry and bother it, do you think, or is that just going to be on physical goods?
Yeah, I think the tariff question first, it's going to be, even if they chose to put tariffs on services and software, it's just quite hard to monitor, when things are being delivered down down cable and down fibre. So there's unlikely to be first order impacts. I think where you see impacts, it's in the sort of backing up the supply chain for the infrastructure build out. Now I know chips and other things have been excluded from that for now, but you don't just need chips to build a data center, right? There's a lot of stuff going into those. So I think it may well impact the compute, but probably not the software and the services. In what was it? Sorry, what was the first part of the question again?
Why is
US?
the
Yeah.
States doing so well with the whole of Europe and all of China?
Look, I do think there are some really interesting businesses in Europe, but are generally speaking for sort of big horizontal plays. If you look through the history of VC, for the sort of horizontal, like a Thorford or a Devon, solving a workflow or providing a product that kind of every business everywhere could use, the winners have historically come from the US because there's a big homogenous home market where people can scale quickly. And so if you look at sort of infrastructure layer generally, that's often come from the US throughout the technology waves. And I think there's just more Stanford grads out in the valley who've been tooling around with machine learning for longer than there are in some of the European markets. That said, some of the very key figureheads in the development of machine learning have come from London and Paris. So it's not. I just think the money's there, the ecosystem's there, and the customers are kind of scaling quickly. I mean, Devon and others, they're mainly serving the Microsoft of the world right now with their product. So, but I don't think it means that there's nothing coming from Europe. Mistral, I mean, we speak to those guys quite a lot. They've got a really interesting product, but I think it will probably persist in the patterns of history.
Any other questions for Luke?
So, what do you think about the advent of super AI, where the super intelligent AI is now coming out, and they're saying there's going to be another big technology wave. So you've got agentic AI, and now there's super intelligence that's coming out, and by the sounds of it, it's not just, it will look at a problem and come out with a solution without you having to prescribe what the problem is necessarily.
Yeah, I mean, that's sort of straying slightly into the realms of sci-fi, but it is coming, I think already some of these reinforced learning models are genius level intelligence. You give them time, they go away and they think about things. And our view is, even if LLM improvements stop today, the tech is already good enough to kind of, mold agentic models to do lots of very cool things for the next decade almost, I'd say. So the tech's already there. Will there be a huge improvement in the underlying kind of probabilistic mechanics of an LLM? I mean, they've already fed these things the whole of human knowledge, so there's not more stuff to feed into them. I think the question then is how good can the agents get at iterating problems? In terms of super AI, I'll leave that to you on your bit. But
There's the age-old argument about singularity.
yeah,
And most experts in the US, including Mark Zuckerberg, now says it's within 8 years. I think the question is not really whether it's coming or when it's coming. The question is what happens when it does. And I think there's a primary difference between the European approach and the American approach. The American approach is threat and opportunity at the same time. So much of the adoption, although the US won't openly talk about it, and we hear it because we're meeting early stage companies selling to them, is in defense. So, and defense is one of the largest budgets in the world. And right now, the early stage market is going through an evolution in like investing into quote unquote defense tech. And so that is one bucket. What happens next? We don't know. But I think the ultimate argument is, even with superintelligence, do we augment or do we replace? I don't have an answer to that, but it is where capital will be spent, in augmenting or replacing.
There's an interesting kind of long-form article written by one of the founders of OpenAI called AI27. You can Google it, and it runs two scenarios on superintelligence. One which ends with sort of extinction of humanity, and one which ends in utopia. So it's it's worth a read to sort of see how people at the forefront of this think things might evolve.
And what I was seeing, if you thought that actually will it wipe out software companies? Because just with Gen AI at the moment, I ask it to do something, it can model something for me that perhaps would take me 4 days, would take a day. do you think it's going to get to a level of sophistication that actually you'd be quite worried if you're a software company if these things get too sophisticated?
Yeah, I think if you're a software company, you stick your head in the sand and don't do anything, then definitely. But you know, you can code something in 4 hours. Well, our team of engineers at our software company are using Replit and Devon, and they're coding a lot more than they used to. So I think that they've got an inbuilt advantage. You don't want to give that up. We did a whole hackathon at HG. We took the whole firm off, and everyone was sort of spending a day messing around with Replit. Basically, the task was, can we do each of ourselves out of a job by kind of coding what we do? And Replit's a pretty cool bit of software, but you end up with something that looks quite shiny, is kind of 60% of the way there, 70% of the way there, but actually to get better, you then have a sort of long diminishing returns sort of fine-tuning that will take much longer to actually be very, to solve the problem you're really asking it to do consistently. So, I do think it's short-circuiting lots of development, but it's not going, I think it's not going to overnight change the playing field for existing software companies.
Thank you, Luke. And I'm interested to know what the prize was for the person who designed the AI that put them out of a job. So we've looked at we've looked at global public equity, private equity on the transatlantic business. We're now going to look at an earlier stage investment cycle at venture capital. We've got with us Jai Kumar from Molten Ventures. Molten are one of Europe's leading technology VCs. The company's listed on the FTSE 250, and it's invested in a range of AI enablers, AI beneficiaries from semiconductors, fintech, training, even online deliveries. Enough. Thank you.
So I'm afraid I don't have a fancy presentation like my esteemed panelists did. We've done a few things with Edison before, so some of you might be aware of who we are and what we do, but I'll just give it a quick. We've been around for about 20 years, early stage technology investors across Europe, typically investing at Series A and Series B. What that typically means is Series A is post-product, early revenue, Series B is early stage of scale, normally 5 to 10 million in revenue. The group consists of about 12 investors, all investing across 4 broad verticals. The first and the largest of which is enterprise software, which is about 60 to 70% of the portfolio. 10% of the portfolio is in consumer, another 10% in digital health, and the final 10% in hardware, specifically semiconductors. So putting the AI sort of lens on where we have been investing, especially in the last 3 to 4 years, it has primarily been on the fintech side of things, healthcare side of things, and we also have invested in the semiconductor side of things. We were investors in a company called GraphCore, which has been acquired by SoftBank. I think today, we've done a bit of math on how we see the market size evolve between what is available today to software and what that could become in about 10 years from now. Because we're typically investing in a 10 to 15 year cycle. So we need to be able to get that in the first 3 and ride the best ones to the end. Otherwise, we will not be in the right point, paying the right valuations. There are some numbers out there that we've kind of recut into our own presentations. Today, if you take the global AI market size, it's roughly about $500+ billion. And we expect this to grow at a 19 to 20% CAGR over the next 10 years to roughly a 2.5 billion size, 2.5 trillion, sorry. And I think when we look at sort of how you cut that up and where time is being spent in Europe, there are 4 different layers, some of which my panelists have also covered. The first of which, and this is where Europe is thriving and has quite a lot of success stories across various different parts of Europe, particularly in Germany, France, and the UK, is in the application layer, where you're developing software built on the existing LLM models produced by the big companies such as OpenAI and Anthropic. The second, and this is picking up steam in the last 9 to 12 months, is the middle layer where it's all the dev tools. So the tools that have to empower the engineers. You've got examples like VR-V8, which is a vector database tool. We spent time on a company called LangChain, which is the application framework, which is the largest one in Europe. Mosaic ML is one of the hot deals. These are 3 deals they're not just proprietary to us. Every tier 1 VC in Europe has met these companies, and they're all thinking about how do they pull the trigger at which stage. Then you have the intelligence and the foundational layers. Molten has been internally quite clear that we are unlikely to invest in a foundational layer, and this goes back to a question earlier about why the US is more competitive on this front than Europe. Part of that actually is something that Mark Andreessen at A16Z calls the quote-unquote the American dynamism. It's sort of how they approach the problem to begin with, and then it's the weight of capital. They have the size of rounds that are significantly bigger than a European size of round. So we have in Europe what we call the alphabet lag. So a Series A in Europe is a Series B in the US, just by size and dollar valuation. And that's just simply because of the size of capital available to the entrepreneurs in the US. The last one is the infrastructure layer, which is the NVIDIA, the graph cores, and so on. We have been invested in graph core. We are actively out there meeting companies who are inventing the next generation of chips. We haven't invested in a new one since, but we're close to one or two that might be interesting. But the general sales cycles for hardware, specifically semiconductors, is quite long. And so you have to be able to make an investment pre-revenue, post-product, which is something we don't do very often, but we do with chips. So that kind of gives you a flavor across the AI sort of supply chain of where we're investing. I think the other thing that's important to note is that when we look at the market today, the vast majority of the effort of our team is spent specifically in the verticalized software layer. So example earlier from HG on payroll, we're already looking at second, third order consequences of automating payroll. And automation is just one layer. It's intelligence on human labor and intelligence that can be cross-pollinated across multiple markets. So if you understand how much, just using a bad example, but if you understand how much a software engineer in London gets paid versus Cambridge or Oxford, that's one data point. You don't have to be the same provider of the payroll to have that data. You can cross-pollinate it from job specs. So how quickly are you scraping? How quickly are you actually putting in the data? The second is then to understand how that arbitrages against other parts of the world. Then you have the question about the deep-seek cost saving, because the cost of engineers in other parts of the world are significantly lower. Cost of compute is significantly lower. So we're working out whether second, third order consequences will work in the favor of this company, because we have to bet on what can go right and how can it go very right, not what can go wrong, because everything can go wrong. So that's the hard part about what we do. And the second part of that is which software layers actually augment one of two things. The first is cost, the second is revenue. The cost argument is generally easier to make because it's rational. And so typically, if you're showing up with an agentic workflow in, for example, accounting month-end reconciliations, it's very easy to say you're going to save your team X number of hours and that's worth Y. And a CFO will take a rational view on that. Okay, that's worth my time, it's worth the experiment, it's worth me paying you between 30,000 and 100,000 a year to see if it works. If it does, then you move into revenue, because the people who are freed up start creating higher level work. And so we're now working out whether these companies have second, third order revenue opportunities in front of them. And I think the other part of this is also thinking about some of the sectors that we've been spending a lot of time already historically. For example, in healthcare. In healthcare, there are dramatic outcome changes. For example, in mental health. So we're investing in a company called IESO, which does CBT using LLMs. It has already been proven with data that the impact is significantly higher than traditional CBT approaches. So what do you do with that? Who adopts it? How's it paid for? These are areas that we're spending a lot of time in. That's a sort of quick whistle stop.
Thank you, Vinod. Thank you, Vinod. Luke mentioned the support that HG gives their companies in terms of implementing AI and being on the curve in terms of how they leverage it. Obviously, Molten's got quite a diverse set of companies, but can you touch on, I guess, the support, the value add that Molten gives to its companies in terms of enabling them to be at the forefront and to make the best use of artificial intelligence?
Yeah, so we actively manage about 75 plus companies, and in the portfolio there's about 115 accumulated over a long period of time. That has led us to be able to cross-pollinate ideas across at least 75 founders at speed. So the value add piece, there's two parts to it. One is the taking of a board seat and the advice that comes through a partner that needs a deal that's on the board. The second is the back-end support of actually cross-pollinating talent, cross-pollinating revenue opportunities. So we have a team of about 3 people that work out value add opportunities around the world. Typically, it's introductions to clients in APAC, US, and Europe. And that's worked out through the big names, the big banks, big corporates, and some of the hyperscalers. So those are the three big buckets where we make introductions. So the team spends a lot of time moving up the chain of command in various different product areas. And the last one is really in data. So we collect data across different levels of efficiency. This is beyond just the P&L efficiency. It's more like, what does a product squad in company X look like versus company Y? So is it a Scrum-based approach or is it a sprint-based approach? And do you have an approach that cross-pollinates that really quickly? And therefore, are your engineers actually getting super scaled faster than any other company is? Because these micro gains compound. And at the early stage, that compound is what we're looking for. So when we get our teams talking to each other, we'll basically present the data to them. We won't name the company, but we'll just say, look, here's what it looks like across 3 different companies. You guys should speak. And then we find that actually immediately that's starting to create outcomes for all of them.
That's helpful, thank you. Do we have any questions in the audience specifically for Vinod? No? Okay, so opening up the panel to everyone. Maybe a very general question. What is the one risk that might slow down development? You know, what are the key risks that you are seeing? Is it energy regulation? Is there anything out there that you think could almost slow down this runaway train that we've got with artificial intelligence?
Yeah, I think, ultimately power demand is going to surge through AI from the data centers. However, that bottleneck is sort of slowly being resolved in the US, and nuclear power will come through, renewables will play a big role there. However, more interesting, I actually think within companies and adoption within companies, we sort of in RC initially thought it was the cost of rolling out AI which would be the big issue, but actually when I sit across the table from CFOs, it's sort of a culture thing, and there is the company set up from the top to adopt AI? And we use the example a lot of Walmart and Target. Now, Walmart's a big position in our AI fund, and the reason being is they've invested heavily in AI several years ago, and it comes from the very top, the CFO and the CEO, on what technology can do, and they follow an exploring approach. They want to innovate, they want to see what the new models can do for that business. You then sit across the table from the CFO of Target, and he's got many other issues to think about. So it's a real top-down approach, which I think, and that can be a barrier for a lot of companies, and for us it's a great opportunity to pick those AI winners, particularly in the non-tech space.
Great. Vinod, anything else you'd want to add to that?
So there's this age-old debate between speed of going to market versus speed of innovation. And these are the two big things that startups and incumbents compete over. One can innovate faster, one has to figure out go-to-market. And in the current AI race, when we look at companies that are going at seed, Series A, Series B, Series C, you can see that some of them have hit what we call the early plateau, meaning the revenues are growing initially 100% year on year, and it quite quickly comes down to 50, then it's 30. For someone to do that within the first 5 years of their life, it affects the long-term outcomes, because the best in class used to be triple, double, double, double. Okay, if you do triple, double, 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 you're on track to unicorn status. And we're finding that even with AI, the triple exists, but then the next double, double, double is really, really hard to do. So what is that saying? It's that the customer who's buying it is not growing their budgets for you, which means that you're either selling a single vertical that you're very good at, and you don't have upsell, meaning your product doesn't have additional features that you can sell more of. There are no more seats to be sold into. That is for me a challenge, because if you see that at Series C, then the opportunity that you've done at A is not going to yield a big enough result, because you're getting diluted, the valuations are coming down. So for me, it's more of the speed of the adoption of what the corporates in Europe can do.
Thanks. Any questions from the audience for any of the panelists? Neil?
Dan and I have been debating whether it's the technology or the sort of end use case in terms of where you see the real opportunity in AI. And I'm curious, as you're investing in real businesses as well as the technology businesses, where do you see the power dynamic lying? I.e., who is capturing most of the value? Is it a RELX or is it further down the technology chain?
I mean, I think as a group where we are both trying to sell kind of AI-enabled product, but we're also consuming kind of AI tools into our portfolio companies. I mean, I think for now, the two clear product market fits for sort of AI have been coding assistants, GitHub Copilot, Devin, Replit, etc., and then the customer success side of things. And then there's lots of experimentation going on everywhere else, loads of other stuff happening, but those are two kind of very clear product market fits, and there we do see the economics going to some of those kind of, some of those providers. Now they're backed up because they can't serve their customers fast enough, but that's quite a good place to be when you're pricing the product. Elsewhere, I think it's still a bit unclear. You see lots of people kind of trying Claude in their daily life and figuring out things that it's helpful with, same with OpenAI, but people are still generally experimenting, and the vast number of people in this room will have kind of had a go, but maybe aren't using it, aren't integrating some of these things into your daily workflows yet. It's easy, you probably are, but but I think so. I think it's kind of too early to tell, but where you've seen a really good product market fit, you can see the providers, the companies getting that. Now the customers are also getting a good ROI as well, so it's one of those kind of classic win-wins. But I think for most processes it's too early to tell. I don't know what you're seeing. But
I mean, in public markets, that hyperscaler capex chart is the key one that we watch. And until that peaks out, we still think there's quite a decent investment spend that's going to occur in infrastructure. So that's semis, but it's also electricals, it's power companies and so on. And as adoption increases and companies sort out security, cultural issues, it'd be interesting to see whether the benefit goes from the infrastructure players into that sort of software layer. Now, pretty bearish on what traditional software companies, how they're positioned currently, and then ultimately into the end users. So do you almost skip a leg and go straight to the end user? But for now, we're very much leaning towards still the infrastructure layer, given our view on hyperscaler capex over the next couple of years.
We're on red. We've heard from three fantastic technology investment companies, Patrick, Luke, Vinod. Thank you very much for joining us. I wanted to ask, how would you play this market? How would you play the AI cycle without investing in an investment company? Because obviously this is a hugely fast-moving area, and the dynamics are changing very quickly. But I think in these three companies, we've got fantastic access to a diverse range of companies who've been invested in by real experts. So thank you, everyone.